upside of market crash for your IRA. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial, and welcome to another episode of Adam Talks. We've got a new thumbnail. So if you're watching this on YouTube, you can check out our new thumbnail. Been doing this podcast over 5 years, so thought it was time for a little reimagination, a little bit of a new design. So kind of cool. Hope you guys enjoy it. And let's get right down to business. So with a market crash, we all woke up on Monday, August 4th, and saw that the Japanese markets were down 12%, their biggest drop since 1987, and actually August 5th, 2024. And we woke up where the US markets were down 1,000 plus points. Now, since they've rebounded a bit, still very volatile. But when it comes to owning stocks, mutual funds, ETFs in a traditional IRA, there is actually some very valuable tax opportunities when the market drops, or more specifically, when an index or an individual stocks. And that advantage is called the Roth IRA conversion. So what the Roth IRA conversion is it allows you to take an asset like stock or cash, but stock for this discussion, and based off the fair market value on the date of the conversion, not when you bought it, but what its fairly market value is on the day you want to convert it, you would then be able to move that asset in kind from a pre-tax IRA to a Roth IRA. Okay, and I'll get through the advantages in a moment. Tax would be due on the fair market value of the conversion, so ordinary income tax. But the advantage is once the asset's in a Roth IRA, so long as you're over 59 and a half and the Roth IRA has been open at least 5 years, everything you pull out of the Roth IRA is tax-free. Yeah, tax-free. So yeah, the downside of going into a Roth conversion process is you have to pay ordinary income tax on the amount you convert. So let's say you own 100 shares of Apple and it's, I don't know, $25,000. You want to convert pre-tax to Roth. That $25,000 in the example is added to your 1040 as ordinary income, and you pay income tax based off the aggregate amount of all your ordinary income, including your W-2 and the amount of the conversion. Okay, so you can play the tax bracket game where if you have wiggle room in that particular tax bracket, then a conversion could make even more sense. For example, if you have net operating losses from previous years, you can use those net operating losses to offset any future income vis-a-vis the conversion. There's specific strategies, oil and gas strategies, which I've actually talked about in my new Mastering the Self-Directed IRA book that was just released. There's a whole chapter how you can actually do a Roth conversion and then invest in an oil and gas investment, and the losses from the oil and gas investment would offset any of the, well, a lot, if not most of the income from the Roth conversion. I talked about tax brackets, right? So let's say you made, I don't know, 300,000 bucks, okay? And that's a 35% tax bracket. Well, if you're married, filed jointly, let's say you make 300 grand, married, filed jointly, you're in the 24% tax bracket, okay? But that tax bracket actually goes from 201 to 383, where you stay in the same 24%. So let's say your income was 300, you have another 83,900 to add income without going from 24 to 32, which is the next tax bracket, right? So there's a lot of really interesting strategies. Or maybe you're in a very low income year for whatever reason, the conversion makes sense. So when I see a drop in the market or a drop in a stock I like Tesla, I look at it as an opportunity. Now, I've been fortunate to kind of make all my contributions, 401k, and I've done a lot of conversions over the years in Roth. So I'm sitting pretty, all my retirement accounts are in Roth. Why do I want to do that? Because when I'm 59 and a half, which is only 10 years away, whatever I need out of the Roth IRA, I can just take out, put in my pocket, tax-free, penalty-free. Where if I had a traditional IRA, I pay income tax on that amount. Okay, so my thought process, and I think I'm right, is yeah, doing a pre-tax IRA or pre-tax 401k contribution is advantageous in the moment because I get an immediate tax deduction, which is great. I'm not going to argue with that. But if, let's say, you're in the 24% tax bracket, a $7,000 contribution is giving you a $1,500 benefit. My thought is that over the next 20, 30, 40 years, I'm going to generate a lot more than a $1,500 tax benefit by investing. So if you look at the market, and obviously I'm talking, we're in mid-August 2024 here. This podcast will be released around then. So if you look at Nike's down 30% plus. Apple's only up 7%. So even if it's up a lot less than it was, which makes converting even it's still attractive. Tesla's down around 7% or so. Actually, it's down around 19%, excuse me, after the sell-off. There's some really good companies you guys may own that are down, like Expedia is down 22%. I own that. What else do I own that's down? I do not own, let's see what else. I talked about Nike. Etsy, I have some Etsy stock. I like that. It's down 33%. Boeing is down 36%, roughly. Intel, right? The big one's down 60%. Walgreens down 58%. And then some really good companies that are kind of flat, that you may say, hey, this is a good opportunity to do a conversion. Target's only, Target's down 6%. It's a great company, obviously. If you like the airlines are, most of them are down. Delta's down 5%, United down 6%. The hotels, which I really like, Marriott's down 4.5%. Even the oil company, Chevron's down almost 4%. So Raymond James down 3%. So some really good companies are down. And obviously the risks in the conversion are this, right? You convert when, I don't know, Apple's at X dollars, and then it keeps dropping, right? So you never know. Apple's at around $212 when this podcast is being recorded. So let's say it drops to 100, God forbid. Now you pay tax at 212 and you could have done the conversion 100. You never know, right? We can't predict the future. You kind of have to decide what you feel comfortable with, what you think the low in that stock is, or what you think is a good price to do the conversion. Should you do a conversion, right? That's the $1 million question, or maybe $10 million question, depending how big your IRA can get. I think the following are the items I would consider when doing a conversion. Number one, can you pay the tax, right? If you have no income, if you don't have no ability to pay the tax because everything you have in your bank account is being used, probably conversions may not make sense. Even though it sounds good, it may not just be a feasible option. Number two, your age, right? Doing a conversion at 32 is better than 82. A lot more opportunity to grow. Although it's facts and circumstances, right? If you're 82 and you have a lot of losses and you could do a conversion for pretty much free and then have a Roth IRA where there's no requirement of distributions, so you don't have to pull that money out if you don't want to, and you can save it for your spouse, your kids, and they have a tax-free legacy from you, that could work too. So that's what I'm saying. It's all facts and circumstances. Another reason to work with IRA Financial, we help our clients do the analysis. We have some pretty cool AI gadgets that can help decide whether Roth conversions are right. Obviously, you never know, but this is kind of the experience and expertise we have that I think is super beneficial. What else would I say? Yeah, what's your investment strategies? What are your likelihood of success? If you're a really, really great investor, then conversions will probably make a lot more sense than if you're a kind of crappy investor that generally picks the wrong stocks, right? Because, we all remember Silicon Valley Bank or Enron or Lehman Brothers. You don't want to convert at X and then it goes to zero, because obviously you just pay tax for no reason. Because if you left that stock in the IRA, it would be worthless, but at least you wouldn't pay tax on the conversion. So it's a double loss. So your ability to invest is important. Your age is important. Your ability to pay the tax. The last thing I would say is, what do you think your income tax bracket will be when you retire, when you're post, 60 years old? If you think you're going to be working your whole life and are going to be in a 20, 30% tax bracket, then a conversion makes sense because you're going to save that amount on the distribution you pull out of the IRA. if you feel like you're going to be retired playing golf, living on a beach, you need very minimal income, Social Security, maybe a little bit more, tax bracket's going to be, relatively low, 10, 12%, then maybe a conversion doesn't make a lot of sense because you're only saving 10, 12% on what you pull out. So it's not a monumental savings. Okay, another factor. There's a lot of factors that go into this. The most important thing is, I think, your ability to pay the tax, your age, and your goals. Like, what do you really want to do with that money? If you really think there's some home run potential, you're going to invest in the next great unicorn stock. Got a great hedge fund that's going to give you 25% returns. Conversions do make a lot more sense than, hey, I'm going to buy an annuity and get 3% returns. At that point, I probably wouldn't do a conversion. So falling stock markets, I think in the IRA has a lot of opportunities. Now, if you're in your 70s and you need the money to live, falling stock market is no good. Okay. It's bad, really bad, because you keep pulling the money out to live and your assets are at a lower position, or you have to sell assets to get liquidity and you're selling into a downward market. That's never good. Even though there's no tax when you sell that asset, you don't want to take money out of an asset that's being depleted. So this podcast is really more for everyone that's before age 73, before the required minimum distribution age, or even if you're over 73 and you don't need the money, you have other sources of income, then thinking of a Roth conversion when you have a asset like Tesla stock or S&P 500. Now, the Dow is up about 4%, NASDAQ's up about 12, S&P 500 is up about 10 or so percent. Again, this changes daily, so bear with me, but you get the idea. I don't know if I would convert indexes funds unless you really think they're going to take off in the next year or 2 years. Maybe they will. But if there are particular stocks like Tesla, I keep saying, because I do own a bunch of Tesla, and it's down 19%, maybe it's a good opportunity, right? Apple's only up 7%. I think I'm still very bullish on Apple. I think people are going to have to change their iPhones with all AI. There are some companies I'm super bullish on that I keep buying stock. So like Uber has been up. It's up about 16 or so percent. So I don't know if I convert Uber today, right? If they go to driverless cars, like Uber's profits are going to jump 60, 70%. So there are some stocks I like to follow. And I'm always looking for downward movement, even if they're up year to date, but it's when you buy them, right? I may have bought Uber and at a higher price, and even though it's up for the year, it's still down when I bought it. So just kind of giving people broad parameters, some ideas to consider. If you have a pre-tax IRA or 401k, you can do in-kind conversions in a 401k plan. Most plans allow for it. It's just always be thinking, right? So when you're watching CNBC or on the Wall Street Journal app or whatever, and just kind of seeing, oh my God, the market's down 300 points, or my stock's down 6% today. Yeah, it's not great, right? I'd rather go up. But sometimes I say, you know what? I still have some conversion power. It's not a horrible thing. I get some value play here. I'm going to convert at a lower price. And I've been doing this really since the last 15 years. So as I mentioned, I'm all in Roth now, but I used this strategy over the last 15 years. So every time there's a pullback, I always, first of all, have some powder, and I'm always buying more assets. But when it comes to conversion, what I did is I converted over time, and I converted individual assets like stocks. Sometimes I converted ETFs and mutual funds when I just was in a good position because I thought the asset was undervalued. And listen, I think you got to be long-term bullish on the US. We have the strongest economy in the world. No matter what you think politically, the US dollar is still the strongest. There is an unbelievable amount of capital influence this country. No matter who the president of the United States is, it's still the greatest country. No one's moving to China or Russia or Iran. People are coming to America for a reason. Okay. So I am super bullish on this country. The markets on average are going up 9 to 10%. Generally, it's over 10% over the last 100 years. So the retirement account investment cycle should be long-term. You shouldn't be investing in your IRA or 401k for the next year. It should be for the next 30, 20, 40 years. So if you are thinking, hey, we're in the greatest country in the world, I have access to some of the greatest companies, right? If you look at the market cap of US companies globally, it keeps growing, right? Compared this to 25 years ago, the global market cap of US companies is way higher than it was 25 years ago. All the great technology, whether it's AI or anything in the future, will be developed in America. Why? Because it harnesses creativity. Not in China, not in Russia, not in Iran, not in some of these other backwards countries. So if you are bullish in America and there is a pullback in the markets, my thinking, again, I'm not telling anyone what to do, not giving investment advice, I'm just a tax lawyer. But from a tax standpoint, convert low, right? Just like you want to buy real estate or buy stocks low, you always want to try to convert low and just have a long term to appreciate the growth. So even if you mistime the conversion, but if it's a good asset like Walmart, Target, Apple, Google, Alphabet, maybe Uber, I like Uber a lot, and I'm going to hold that asset for 5, 10, 15, 20 years, that stock's going to go up. Okay, so I'm ultimately going to be in a cash positive position anyways, or an asset positive position, because this is a long-term play. I'm not worried what's going to happen around the corner. I'm worried what's going to happen 5, 10, 15 years down the road. So I think this is a really valuable strategy. It's worked really, really well for me. I've done it over 15 years, and I look at my Roth IRA, Roth 401k accounts, and based off all the conversions I've done, I'm way, 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 way up, way up. Not because I'm a great investor. I diversify. I own a bunch of equities. I own ETFs. I own real estate. I own private placements, private equity, hedge funds, venture capital funds, and I own real estate. And I even own I own a lot of cryptos, and I own a little bit of gold. I've been a little more bullish on gold in the last year. I never was super bullish on gold. I have in the last year. But I believe in a diversified portfolio. I do believe in alternative assets complementing traditional investments, but I do believe in traditional investments. I think it's important to have exposure to traditional equities. I think there's really growth opportunities, and doing it in a Roth can give you dividend tax-free cash and also tax-free gains through the Roth IRA or Roth 401k. So that's it. A little bit of a rainbow and a poor market. Just think in the back of your head, yeah, it's not the best that the market's down X or my stock's down Y, but the bright side, I have potential Roth conversion opportunities. Now it's up to me whether I want to take advantage of it or not. So that's it. I hope you enjoyed today's podcast. Thank you for listening. Please subscribe to I think this is a really, really great podcast. I've been doing this 5+ years. So obviously I feel really strongly about it. If you're watching on YouTube, appreciate it. Also, don't forget to subscribe. We drop 3 podcasts, 3 to 4 videos a week, including a YouTube live, generally every Wednesday or Thursday. And if you are a subscriber, you'll get notified when I go live. Otherwise, have a great day, and I hope to see everyone again next week. Take care.